Welcome to our Hurst Cycles webinar for the 15th of January 2018. My name is David Hickson, and in today's webinar I'm going to be discussing the next big event, I believe, in Hurst Cycles terms that we are going to experience in the stock markets, which is the formation of a peak in those markets. Before we take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. I am not a qualified financial advisor, and so nothing that I say in this webinar should be construed as advice to either buy or sell anything. So let's take a look at the markets. And in November, I did a webinar in which I discussed an approaching peak in the stock markets. So I thought it would be very interesting to start today's webinar by going back to the analysis that we were looking at in November and then updating it and bringing it forward to January 2018. The reason why I think this should be interesting and why it's fairly important is because as a Hurst Cycles analyst, of course one's analysis develops over time, and there tends to be a little bit of a misunderstanding sometimes. People believe that because an analysis is updated or refined, that it is completely changed. And it's one of the things that really disconcerts me about several other approaches to financial markets, is that you can perform an analysis and then as time passes, one has to completely change the analysis, by which I mean, the analysis pretty much stands on its head and you're looking at something completely different. That is not often the case with a Hurst Cycles approach to the markets, and it's a very important detail. Of course, we do update our analysis with every passing day. As we get new data, we're updating that analysis. And sometimes, yes, we've been completely wrong with our analysis and we have to completely change it. But in my experience, that doesn't happen very often. Most of the time, the markets deliver what we expect in terms of our analysis, but they often surprise us and deliver it in a fairly surprising way. And so that's why I thought it would be interesting in today's webinar to go back to November, remind ourselves about what we were looking at then, and then skip forward to present day, January 2018, and take a look at how the analysis has either changed or been updated. And in my opinion, nothing has substantially changed about the analysis at all. In my opinion, we're still looking at the same analysis, and we're still expecting the same peak. The only slight change, if you like, is that that peak has taken a little longer to develop than we originally expected, or than I originally expected. So let's just quickly remind ourselves about the analysis that we were looking at in November, and I'm not going to repeat all of that because of course that webinar is available on YouTube. You can go and have a look at it if you haven't seen it already. But in terms of the peak and the reason why I was expecting a peak in the stock markets, let me just remind you about that. I spent some time discussing why I believed that the peak in about the middle of 2015 was a peak of a very prominent cycle, probably the nominal 9-year cycle. It could be measured to be about a 7-year cycle. Nevertheless, I think that the peak in 2015 was probably a peak of a fairly important cycle. That was the analysis that I presented in November, and the peak that followed that was, of course, the next 18-month peak, which is over here, which was the peak in sort of late 2016. And the next peak, the peak that the markets are now heading up into, or at least in November we're heading up into, was, I discussed the next peak of the 18 years, the 18-month cycle. So in November I was speaking about an approaching 18-month cycle peak. Okay, that's what we were looking at, and I spent quite some time discussing that. So now let's take a look at this same chart. Did I mention that this chart has data only up until November? I should have made that clear. This chart, you can see the last day of the data on this chart is in early November, which is when I did that webinar. So this is in fact exactly the same analysis with the same data and everything going back to November. So now let's look at the same chart with updated data, and that takes us all the way up to now, up to last Friday. So here is that chart. I beg your pardon, that's not actually the chart. Here is the chart. Here we go. Okay, we were looking at a variation on the analysis that we discussed in November, but here is that same chart, and we have the same long-term peak here in 2015. We have the same 18-month peak here in late 2016, and here is our nest of highs for the next 18-month cycle peak. So what has happened? What has transpired in the 2 months since November? In fact, the analysis has effectively not changed at all. There are a few subtleties. For instance, if we were to look at the details, you would see that this 20-week peak over here has been probably more correctly placed at that peak. I think that was in late July of last year, whereas in the previous analysis, the 20-week peak was a little bit earlier. So that peak's been moved. It's probably a fairly sensible adjustment to the analysis. But the underlying sort of bigger picture about this analysis is that we are still expecting an 18-month cycle peak to form. If we zoom in, let's just zoom in on this little bit of the data, and let's pull that down. You can see here what is called the nest of highs, which is the arrangement of these circles and whiskers for the 18-month cycle peak, which of course forms a triangle, sort of standing on its head, up at the top of the chart there. That indicates the most likely expected time range for this peak to form. So that's quite an important point to make. I'm speaking about a peak of, in this case, 18-month magnitude. And in November, I said I'm expecting this peak to form soon. Today, I say I'm expecting this peak to form soon. And I realize I should probably be a little more specific about what I mean by soon, because some people might assume by saying there's a peak expected to form soon, some people might think I'm speaking about a peak forming before the end of this week. Well, that's not the case. This is an 18-month cycle peak. And so by soon, I mean, within a few months, within a range of a few months, because 3 months would be, 1/6 of the entire cycle length. And so that's a fairly acceptable range of time. So we're looking at a range of a few months in which this peak is expected to form. So looking at this analysis, you can see that we are still expecting a peak to form in the markets. So let's step back a little bit and let me address quite an important issue. When we are speaking about a peak forming in a stock market, why is it that peaks are so complicated? And over the years that I've been performing Hurst cycles analyses and writing about and speaking about those analyses, I've often said that peaks are complicated because peaks are complicated in stock markets. Why is that? Well, one of the fundamental principles that Hurst defined in the 1970s was the principle of synchronicity, in which he stated that the troughs of the cycles that influence financial markets are synchronized, whereas the peaks are not necessarily. And so if we, let me just switch to a different chart to discuss this, and let's display some semicircles. There we have some semicircles, and let me just zoom out a little bit, and I can show you what is meant by the troughs being synchronized. There we go. Okay, so here you can see with these semicircles that the troughs, or the low points, each one of these semicircles represents a cycle, of course. That orange one is the 54-month cycle. This yellow one is the 18-month cycle. And you can see that the semicircles representing the cycles have their low points occurring simultaneously. Okay? In other words, they occur at the same time. That is what is meant by the fact that the troughs of the cycles are synchronized. So the troughs of the cycles occur at the same time. Now, because the troughs are synchronized, it means that the peaks are not necessarily synchronized. Sometimes peaks are synchronized, but it is mathematically impossible, and I will let you go and figure this out for yourself, but it's mathematically impossible for the troughs and the peaks to be synchronized all the time. So that was one of Hurst's fundamental principles. I've, in my mind, updated that principle a little bit because in analyzing many different markets, I've noticed that some markets definitely exhibit the characteristics of synchronized troughs, whereas other markets exhibit the characteristics of synchronized peaks. And that's an important subtlety, and so we should probably spend just a moment speaking about that. What are the characteristics of a synchronized trough market, and what are the characteristics of a synchronized peak market? Well, let me turn off the analysis and speak about those characteristics. When you have a market that has synchronized troughs, you expect to find in that market sharp, isolated troughs. In other words, the troughs are very sharp and they stand alone. They are fairly isolated. That's an interesting one. That's a bit of an exception to the rule. But generally speaking, because of the mathematics of combining cycles that have synchronized troughs, you have sharp, isolated troughs, whereas you tend to have rounded, clustered peaks. Okay, so the peaks, you tend to get rounded and clustered peaks. In other words, you get sort of multiple peaks whenever a peak occurs, whereas you tend to get very sharp individual troughs. And here, if we zoom in, you can see a really good example. Here is a peak. There's a high point in the market that formed in 2015, and you can see how rounded that was, and clustered. By clustered, I mean that there are many little peaks in there, and you could pretty much take your pick of which one you're going to choose as the peak. Most people will choose the highest price, but that's not necessarily the correct peak. Nevertheless, you can see that's a rounded, clustered peak, whereas the troughs that are evident on this part of the chart are fairly clearly sharp and isolated. There we have a double trough, but nevertheless very sharp troughs. Okay, so that's what a market that has synchronized troughs looks like. A market that has synchronized peaks has the opposite. It has sharp, isolated peaks and rounded, clustered troughs. And the reason why I say that, in my mind, I've updated Hurst's definition of the principle of synchronicity. The reason I say that is because in analyzing precious metal markets or commodities, I believe that the opposite is true and that the peaks are synchronized. Go and analyze coffee or wheat or gold or silver, and I think you will notice that those markets exhibit the characteristics of synchronized peaks as opposed to synchronized troughs. However, stock markets definitely exhibit synchronized troughs, which is why in my mind I've updated that principle of Hurst to state that the troughs of stock markets are synchronized, and in other markets you will have synchronized peaks. In some markets I believe you get yet another variation on the theme. In forex markets, for instance, you get times or periods of time when troughs are synchronized and periods of time when peaks are synchronized. Now, why are the troughs synchronized in a stock market, and why are the peaks synchronized potentially in the gold market? Someone who shed some light on that for me was Ray Tomes, who has He is the creator or inventor of the harmonics theory, which is another cycles theory about how cycles move financial markets. It's a theory that dovetails very nicely with Hurst's cycles theory. I spent much time discussing this with Ray Tomes. The two theories take slightly different approaches to how cycles work, but they both shed interesting light on how the financial markets work. The two theories work very well together. Ray was the person who pointed out to me that whether cycles are synchronized at their troughs or peaks depends on the emotion that is driving that market. It's a very interesting thing, and I'm going to spend just a moment discussing it and explaining it, because it's important in our consideration of the formation of a peak in a stock market. The troughs of the cycles in stock markets are synchronized according to the ideas of Ray Tomes, because the primary or fundamental emotion that drives the stock market is an emotion of optimism, of hope, of feeling excited about the future. It's a characteristic of human beings that we like to be optimistic about the future. We like to be productive, and our stock markets represent, if you like, not only the strength of the economy of the country that we live in, but generally the sort of state of our productivity as human beings. And so if we're speaking about global stock markets, we're not speaking about one specific country. Generally, humans are very optimistic about the future. They like to feel that the future is going to be better, that we're going to be more productive, we're going to make more money, and we are going to generally, just create a better future for ourselves. And it's that emotion of hope that drives a stock market upwards. Of course, it is moments of, I want to say panic, but it's not just panic. It's moments of disillusionment that drive stock markets downwards. And it's when we feel disillusioned or suddenly realize that perhaps our hope is unfounded that the stock markets move downwards. Now, those are two very different emotions. They're not direct opposites of one another. And because of the way in which our emotions work collectively as human beings, a stock market will exhibit the characteristics of synchronized troughs because of the way in which emotionally we work. There's a big discussion to be had about that, but that sheds a little bit of light as to why stock markets particularly have synchronized troughs, because of the emotions that are driving that stock market. If you compare that, for instance, to a currency pair, when a stock market moves upwards, it represents, the hope of the nation about the future of the prosperity of their nation and the value of their productivity. However, when a currency moves upwards, you could say the same for one nation, but when it's compared to the currency of another nation, you've got the same emotion working in both directions, and so you tend to get different types of price action. And that's why some currency pairs, some forex markets, in my opinion, exhibit the characteristics of having synchronized peaks, because perhaps that nation's sense of hope or enthusiasm, optimism for the future is overpowering temporarily the similar emotions from the other country. Makes for an interesting debate, but let's not dwell on it. But that is why stock markets have always and continue to exhibit the characteristics of having synchronized troughs. And that is why identifying peaks that form in the market can be such a frustrating process. And it is why I have said so many times, finding peaks in markets is complicated. So let's just take a step back. Let's go back to our workspace in November, and let's not look at the analysis that we're seeing at the top of the chart here, which is the peak analysis, which you might know is an aspect of a new feature in Sentient Trader. Well, relatively new. It's been around for about just over a year. It's a feature I've been working with personally for many years. Because traditionally, of course, a Hurst cycles analysis of a stock market involves identifying the position of the troughs. And so that's why we have these diamonds at the foot of the chart. Okay, that's a traditional Hurst cycles analysis. These triangles at the top of the chart are not a traditional Hurst cycles analysis. They are a relatively new feature in the software because I believe they can provide us with additional insight and can help us to get a grip on what's happening on the peak side of the market. But really to stick to strictly Hurstonian terms, the original principles, we should take a look at an analysis of the troughs. And so here is a chart, again, from the webinar in November, which shows an analysis of the troughs in the market. And let me display the semicircles. I don't even have a peak analysis here. So, we can just consider the trough analysis. So let's speak about the upcoming peak in terms of this trough analysis. So, what is the trough analysis telling us? Well, again, this is an analysis I've discussed in previous webinars, so I won't dwell on it. But I've discussed the fact that I believe that the 2016, what was that? Was that February 2016 trough was a trough of the 54-month cycle, and that the next 18-month cycle most probably is this trough that formed in August of last year. So there's the 18-month marker. So I've zoomed this chart purposefully so that you can see the development, if you like, of this 54-month cycle in terms of the troughs. So, of course, we have 3 18-month cycles in each 54-month cycle. And this orange semicircle shows us the 54-month cycle, and in sort of stylized terms, it represents the cycle moving up, okay, then topping or forming a peak, and then moving down. Okay, it's very stylized, it's balanced, it indicates the market going back to the same level as the start of the cycle, which is by no means what we would expect to happen, but it shows us the way in which the cycles are expected to influence the price development. And so, of course, we have 3 18-month cycles that play out. There's the first one, here's the second one, and there's the third one. So you should be fairly familiar with most of these concepts by now. Within a 54-month cycle, because we have 3 18-month cycles, the first 18-month cycle is expected to be very bullish. And so I can draw the M shape that 18-month cycle produced, and it is, as you can see, a very bullish cycle, right? It moved the market up a lot, and it has a very late peak. So that's the first 18-month cycle. The second 18-month cycle is expected to be less bullish. If we were looking at a neutral market, then we would expect to see a completely balanced M shape. In my opinion, we're still not looking at a neutral market. The market is more bullish even than the 54-month cycle would have us believe. And so it's likely that we're not going to see a completely neutral 18-month cycle here. We might see a slightly bullish cycle. The third 18-month cycle is expected to be, again, less bullish, or should I say more bearish, and it's expected to, of course, take the market down on the other side. Now, you'll notice these semicircles coming in, which are for the 6-year cycle and the 9-year cycle, a concept that I discussed in a previous webinar. I believe it was October's webinar. I discussed the possibility of a 6-year cycle. The important thing is that those cycles, if the 6-year cycle exists, you would consider it. If you think it doesn't exist, then you can just ignore it. But in all probability, the 9-year cycle is definitely turning downwards. So we would expect the bearishness of this market to pick up, and we would certainly expect this third 18-month cycle over here to be a bearish shaped cycle because of the bearishness of those longer cycles. So in terms of the peak, the discussion of today's market, you can see that the market is heading up and is expected to form a peak, which is a peak, of course, of this 54-month cycle. Okay, it's also a peak of this 18-month cycle, which is expected to form soon. So, looking only at a trough analysis, basing our decisions and our understanding of what's happening in the market only on the troughs, we can say that here too we are expecting a peak to form soon in the market. The next big event, and perhaps I should define big event, by big event I mean the next event of at least 18-month magnitude, is expected to be a peak. Okay, so that is why we're here today speaking about a peak, because the previous 18-month trough, I believe, was in August of last year. The next 18-month trough I expect towards the end of 2018 or early 2019. So that's the next trough. And so the next big event is definitely a peak. So that's why we're discussing this. All right. When is that peak going to occur? How is it going to occur? And what kind of a peak are we expecting? Now, what I would quite like to do here is display the composite model line on this analysis. Now, bear in mind, this is only a trough analysis. It's a traditional trough-only analysis. A composite model line is a matter of taking all of the cycle information that we have in this analysis and combining it. So the cycle information has been extracted by the software. Cycle information includes the wavelength and the amplitude and the phasing of all of the cycles. And that information is extracted and it is recombined into what's called a composite model. So it's a composite of all the cycle information. So if we display the composite model line for this particular analysis, there you can see that's it there, that sort of dashed orange line. And that line indicates in the past, let me turn off these semicircles, that line indicates in the past the cycle component, if you like, of the price action given this analysis that you are seeing at the foot of the chart. Okay? It is extended into the future using a completely not necessarily a realistic process. It's a completely hypothetical process, assuming that first of all the analysis is correct, which underlies everything we do here, but assuming that the cycles keep beating with the same wavelength and the same amplitude, then that is what's going to happen in the future. Now, the reason I show it is because it shows us that this market is rising up to a peak over there. And the other thing that it shows us, which I think is really quite interesting, is that it shows us one peak over here, and as a matter of interest we'll look at those dates in a moment. Then it shows another almost equal peak, then another one, and then another one. Okay, so remember what I was saying earlier about how in a trough synchronized market, such as a stock market, you will tend to have rounded and clustered peaks. Well, indeed, that's exactly what this composite model line is showing us. It's showing us that we should expect a rounded clustered peak. And as a matter of interest, let me zoom in here a little bit. And that's gone all the way off the chart. Again, we're looking at a chart here with data only up to November. I'm going to go and take a look at the updated chart in a moment. But this is what we were looking at in November. Okay, so where was this peak? Well, first of all, it expected a little bit of a peak in about December, but it expected this major peak here to happen in about the middle of February. That's the middle of February. Take note of that. In November, we were projecting a peak in the middle of February using a trough-only analysis. The next trough is expected in about April. The next trough is expected, end of June, and then there's another peak. Oh my goodness, I've been saying trough. I'm so used to saying trough. So let me say that again. Sorry. We're projecting forward to a peak in February, then another peak in April, a peak at the end of June, and a peak in August. So those are the sort of potential time zones for peaks to form in the market according to this composite model line based on an analysis performed in November. I think it's quite interesting to note that the level of the composite model line, and the level should never be taken too seriously, but it's quite interesting to note here that the composite model line takes us up to a level of just over 2,800, which is roughly what the market is approaching now. Quite an interesting little side observation. So there are a few interesting things to look at in this terms of this analysis from November. The first thing that I would like to look at is that we've got some very nice, neat nests of lows here at the foot of the chart. Can you see this? And in fact, I think I should zoom in here. I need to turn that pen off. There we go. So let's zoom in and take a look at this trough analysis. Here we go. First of all, nice neat nest of lows in the last week of November. That's for a 40-day cycle. So we're looking at a 40-day cycle trough forming in the last week of November. And look at this very nice neat nest of lows, which I've managed to sort of draw over. There we go. That very neat nest of lows is for the 20-week cycle. 20-week cycle. Remember, this is an analysis done in November, okay, in the second week of November, well, including data up to the second week of November. And so we were looking at a 40-day trough at the end of November and a 20-week trough in the first week of January of this year. Okay, that was the forecast for the trough analysis. Let's take a look at what actually happened, and we will switch to the updated workspace, which has data all the way up to now. We'll take a look at that same chart, which is this chart over here. There is that chart. You can see the recent upwards move. Let's take a look at the updated composite model line. There is the composite model line for the updated analysis. Notice how the shape of the composite model line in the future has changed slightly, but it hasn't actually changed in any substantial way. You can see that the first peak is still expected here in February, as it was previously. The second peak, which in this case is expected to be a slightly higher peak, an interesting subtlety to the change in the analysis, but that peak is still expected in April, or end of March, early April. This peak is still expected, I believe I'm correct in saying, in June, yes, and this one is still expected in August. So we're still seeing those four peaks in the composite model line. Price has come up very sharply, and it's reaching up, as I've mentioned, to that 2800 level, and we're still looking at these four peak markers based on an analysis that includes only troughs. Okay, I'm going to come back and sort of tie this all together in a moment by looking at peaks again, but we observed the details of the forecast for the trough analysis. Let's just see how that played out, and let's turn that off. Let's zoom in. And so you might remember that I pointed out a 40-day trough in the last week of November, and there indeed is a 40-day trough in the analysis, not a very good 40-day trough in the price movement. So what's happening with these troughs? Well, if you do any Hurst cycles analysis by hand, manually, and I strongly recommend that you do that because it helps you to get a good feeling of it, you will notice that identifying troughs in a constantly rising market such as this, really becomes quite difficult because you've got so many candidates, and the market has only been falling for a few days at a time to form each one of those troughs. So those troughs are occurring in the market, but identifying them can be quite difficult. But now remember, we forecast a 20-week trough in the first week of January. Well, here is that 20-week cycle trough, which occurred just a few days early in the last week of December, or potentially, as you can see, it occurred over the weekend following that last week of December. So, right between December and January, if you like. So that was the 20-week cycle trough, which came in right, on cue. So that was a forecast from our November analysis for a 20-week cycle trough in the last week of December. It seems very likely to me that 20-week cycle trough has formed in the market. I know some analysts are still suggesting that a 20-week cycle trough lies ahead of us, but I think it's more likely that 20-week cycle trough has formed. And if we measure from the 18-month cycle trough over there to this 20-week cycle trough, you can see the number of days was 130 days. The average length of a 20-week cycle is 136 days. So, yeah, it came in 6 days early. But it makes a very good position for the 20-week cycle trough. And it also gives us a rationale, if you like, for the extraordinary bullishness that we've seen so far this year. In the first 2 weeks of January, the market has screamed upwards, and Hurst cycle's reason for that, Hurst cycle's reason for a market moving strongly upwards is either because the market is bouncing out of a really big trough, or because it's reaching up to a really big peak. And in this case, I think potentially both of those things are happening, which is why we have witnessed such a strong move. I think that the market is bouncing out of this 20-week cycle trough, and it's giving us a good bounce, and it's reaching up towards the peak. We are heading towards the peak. I should point out at this point that what we have experienced in the S&P 500 and in the US stock markets is an accelerating upwards curve, sometimes called a bowl-shaped curve, and that is an unusual thing to see in a trough synchronized market. It is possible that what we are seeing is the development of what Hurst described as a pseudo-trend. I'm by no means stating that is happening, because it's a fairly rare event in stock markets, but if it is happening, then we need to stay alert to the possibility of a very sharp peak forming. I'm going to speak in a moment about the different types of peaks that we might be able to expect. But before I speak about the three possible peaks that we could expect to form in the market, let's just go back to this 20-week cycle trough that formed over here. Now, in sort of mid-November, I was speaking about a peak forming in the markets, and mid-November's over there. I was speaking about a peak forming in the markets, and I have in the time that has elapsed received a few emails asking, what about that peak then? I thought a peak was going to form and the markets just keep going up. Well, the first important thing to say, which I think I've already said, but it bears repeating, the first important thing is that when you're expecting a peak, you expect the market to rise up into that peak. Okay, the peak has not formed until the market provides evidence that it has formed by crossing below an FLD or a VTL. Okay, we've seen no evidence of that, so clearly no peak has formed yet in the market. It doesn't take a rocket scientist to figure that one out. So some people have said to me, what about that peak? Well, the first part of that answer is that I'm still expecting the peak. I believe that a peak is going to form in the market. There was a subtle variation. I received a couple of emails, 2 or 3 emails, asking me, is this because of a cycle inversion? So I'd like to spend just a moment speaking about a cycle inversion and the concept of a cycle inversion. First of all, to my knowledge, Hurst himself never spoke about the concept of a cycle inversion. I stand to be corrected, and there are people present on today's webinar I know who are more familiar with Hurst's work than I am. There are people that I've had the pleasure to speak with, members of our community who have studied Hurst's work and have a far better understanding of everything that he spoke about in the course of his life. So it's possible that he did mention it, but to my knowledge he didn't speak about a cycle inversion. What is a cycle inversion? A cycle inversion is what happens when, as an analyst, you say we are expecting a peak. Oh, I'm trying to write the word peak. We're expecting a peak, but then what happens in the market is that a trough forms. Okay? And then, with hindsight generally, the analyst will say, oh, well, what we encountered was a peak inversion. So I was expecting a peak, but it actually turned out to be a trough. Or I was expecting a trough, and it actually turned out to be a peak. Now, cycle inversions have always made me fairly uncomfortable, because in a Hurst cycles analysis, I have never in my life performed an analysis and labeled a peak as a trough. I've never said, oh, well, for instance, looking at this chart, I've never said, well, actually, that trough was there. Because, to my mind, that is a peak and that is a trough. And the two cannot be confused. So I don't wish to be sort of rude about the concept of a cycle inversion, but an inverted cycle or cycle inversion can often be used as a little bit of an excuse for being effectively, 180 degrees wrong in your analysis. But let me not be rude, because the concept of cycle inversion is used by some experienced analysts, and they have good reason for speaking about cycle inversion. But that reason doesn't, in my opinion, have anything to do with Hurst's fundamental principles, which is why I never really speak about cycle inversion. So I will never say, well, I was expecting a peak, but actually a trough formed, and so therefore we're witnessing an inverted cycle. I will never say it, because I don't believe that in terms of Hurst's principles and the concept of Hurst cycles, I don't believe that cycle inversion exists. Within other cyclic theories, of course, cycle inversion does exist, and that's very much a separate thing. So I'm not going to speak to that, but I would like to speak about cycle inversion and the concept of cycle inversion in terms of Hurst cycles. So let's just pop up our semicircles again. Let me explain why, in my opinion, cycle inversion is an invalid concept in Hurst cycles, but also why it often seems to happen. And the reason has to do with the synchronized troughs that I've already spoken about. So, okay, here we're looking at a 3-to-1 harmonic ratio. So I don't really want to do that. I want to look at a 2-to-1 harmonic ratio. There we go. So when we are looking at the cycles that influence financial markets, we have a cycle like this 18-month cycle, which is moving up, then it turns down and moves downwards. And up at the top here, we would expect to find the cycle peak. So that's the peak of the 18-month cycle. What happens at exactly the same time as the 18-month cycle is expected to form a peak? Well, what happens is that the 40-week cycle is expected to form a trough. Okay? It's in the nature of the principle of harmonicity and the principle of synchronicity that when one cycle is forming a peak, a cycle shorter than it, and in fact all cycles shorter than it, are forming troughs. Okay? That is why often you will see in the markets when you are projecting a peak, so you're saying, okay, a peak is going to happen round about here, round about the time when you are expecting a peak, the market, frustratingly, forms troughs. Okay? And, so you're expecting a peak of the 18-month cycle, and the trough that forms is a trough of the 40-week cycle, which is still a pretty impressive trough, right? That's quite a big trough. And so that is why often when you're projecting peaks, you find troughs forming in the market, and of course vice versa. If you've been projecting downwards to this 40-week cycle trough, you might have found that the 18-month cycle peak occurs at about the same time. Now I say about the same time because there's a way of resolving this, which is why I believe cycle inversion is not necessary. And that has to do with the M shapes of cycles. So cycles generally come up, form a first peak, come down, form a trough, come up, form a second peak, come down, form the next trough. Okay, so the exact sort of center of the 18-month cycle, when one might expect a peak, is, of course, when the trough is expected, which means that the peak of that cycle should come either before that trough or after that trough. And this is why peaks are complicated, because when you're projecting troughs, you are literally just counting bars. You're counting days. You're saying that's when that trough is expected. But when you're projecting to peaks, you know that the peak won't actually occur at exactly that bar. It's going to occur either before or after. And that's what makes peaks complicated. And it is also why the concept of cycle inversion, in my opinion, is not really an aspect of Hurst cycles. It might have its place in other cycle theories, the concept of a peak occurring when a trough should have occurred, or vice versa. But it doesn't, in my opinion, it's not really part of my my sort of library of of materials that I refer to, cycle inversion. I know that many analysts do use it very successfully, but I don't think it has a place in a pure Hurst cycles analysis. So I've spent quite a lot of time speaking about the complication of peaks and why peaks can be so complicated and how troughs are more reliable. It's time for me to start sort of consolidating what we've spoken about today. And so let me just zoom back out again. Let's come to some kind of a conclusion. I continue to expect a peak to occur in stock markets. Okay, I've drawn a wobbly circle, it doesn't really have any meaning. Let me display the composite model line again. The trough analysis, in my opinion, on a stock market is always the more reliable one. So it makes a very good starting point. And according to this trough analysis, we are definitely expecting a peak to form. Okay, the exact time of that peak could be February, could be April, could be June, could even be August. But the important point is that the next big event, by which I mean an event of greater than 18-month magnitude, is going to be a peak. Okay, there's no question about it. It's going to be a peak. We're going to see some kind of a peak forming in the market. And then, of course, price is going to come down to an 18-month trough towards the end of 2018, early 2019, and then it's going to come down to a really big trough, in my opinion, in 2020. So that is why I continue to watch for a peak to form in the markets. And yes, for the big move in 2018, I'm expecting to be a downward move. I'm not expecting it to be an upwards move, because I'm expecting the strongest move to be a downwards one. What kind of a peak could be forming in the market? Well, there are various possibilities, and let's change back to this chart here and start including the possibility of a dual analysis. So in other words, we're looking at both. Now I seem to have. There we go. All right. So let's have a look at both of these analyses. We still have a nice nest of highs up at the top here. So what kind of a peak could be expected to form? Right, let me display the composite model line on this analysis, which gives us a very different shape. And let me just adjust the zoom so that we can look at the period of time up until 2020. There we go. Okay, let's go up to 2020. All right, so the composite model line on this analysis shows us that yes, a peak is expected to form. Then we're going to get yet another peak. Then we get a move down. Then we get yet another peak. And then we get the move down into the 18-month cycle trough expected towards the end of 2018. Then we're going to expect an even higher peak before the big move down into the 2020 trough. Okay, so how do we make sense of these two possibilities? Well, this possibility includes the concept of a dual analysis, which means that it is applying a synchronized peak analysis to this market. that is a fairly flawed concept, in my opinion, and so I would give more weight to the other analysis. That's the first very important thing to say. I would give more weight to the other analysis. However, there are a few interesting lessons to be learnt from this analysis. The first is that yes, we are definitely expecting a peak to form in the market. That peak might give us a move down for only a couple of months, as indicated here. Then we're going to see yet another peak, okay, with yet another move down, and then we're going to get yet another peak, okay, reiterating the concept that peaks are complicated. And that once one peak is formed in the market, it doesn't mean that we all sit back and just ride the sled all the way down the hill, because we're going to get some bouncing back and forth. So that is one possibility for the formation of this peak. And let me just turn off the composite model line, because I think it's a slightly flawed concept, as I've mentioned on this on any stock market. Let's speak about the kinds of peaks that might form. So that is one kind of peak, is that we get effectively the formation of something that could take the shape of something like a triangle with one peak, then another peak, then another peak, very complicated, and then down towards the end of 2018 we get our 18-month cycle trough. Okay? Then we will, where's my pen? Then we will get another move up, perhaps a blow up above the triangle, and then the move down to the 2020 trough. 2020, in my opinion, is still going to be a very big, important trough. So that's something to take notice of. So that's one possibility, is effectively a kind of a triangle formation, followed by a move down towards the end of this year. The second possibility is that the sort of accelerating trend that we are seeing here develops into a true pseudo-trend. Now, a true pseudo-trend needs to be the kind of price moves that take your breath away. By which I mean, you look at it and you say, no, that's impossible. So if I ask you today, how high can this market go? And then you add an extra 100 points onto that. If that happens, then that's going to be a pseudo-trend. Pseudo-trends are very difficult to define, and so I tend to sort of avoid talking about them generally. But the other possibility is that we do get the development of a pseudo-trend. So the market will really come up strongly. Okay? If a pseudo-trend forms, then what kind of a peak will we see? Pseudo-trends form sharp peaks. So we will see a sharp peak. So that's the other possibility. Coming down into the 18-month trough at the end of this year. 18-month, then we'll get a bit of a recovery, and then we'll get the strong move down into 2020. Okay, so that's the second possibility. The third possibility is that this market returns to business as normal, if you like, and so we have the nice formation of an 18-month cycle trough. Price comes down and forms a zigzag all the way down to the trough at the end of 2018. That's the 18-month trough, 2018, early 2019. Then we get a nice move up, and we're getting sort of regular cycle movements, if you like, and then the low in 2020. So those are the three possibilities for the kind of peak that we might see forming in the market, in my opinion. So I hope that sort of consolidates everything that I've been speaking about. Basically, since November, very little has changed. I am still expecting a peak. Yes, peaks can be frustrating. How do we deal with that? And that's perhaps the most important way to end the content of today's webinar, is how do we deal with this? Some people assume that because I'm speaking about a high point in the market, that I am therefore bearish. Well, I'm not. And let's switch back to the trough analysis while we wrap up this conversation. And let me just do this, and let's just zoom in until the end of this year. Let's speak about this year. Okay, so I continue to expect a peak to form for the various reasons that I've spoken about in today's webinar. I'm looking for a peak. When I'm looking for a peak, one of the dangers of being a Hurst cycles analysis is that is that because you're always looking for the next big event, you can sort of jump on board the ship too early and sort of miss out on the move. So because I'm expecting a peak, it does not mean I'm bearish. Quite honestly, I think if somebody was feeling bearish today, they would have not been observing price action recently. This market is bullish. Okay, there is no question about it. This market is moving up. I don't think this is the perfect opportunity to start buying into this market because I think a peak is approaching. But I'm certainly still bullish this market. Part of expecting a peak is that you expect the market to come up into the peak. Okay, so I'm expecting price to keep moving up. But I am looking for a peak to form. When will a peak form? When am I going to say, okay, that's the peak? A peak forms only, according to a pure Hurst cycles approach, once you have evidence from the fact that a VTL or an FLD, or ideally both, has been crossed by the market. So I would start looking at the FLDs and the VTLs in this market, and when price crosses down below an FLD, then I would pay attention and I would say, okay, now I think that a peak has formed in the market. So if we have a look at the FLDs, since they have played out since the webinar that I did in November, you might remember that I mentioned the 80-day FLD in that webinar, and you can see that price hasn't even come near that 80-day FLD. Price came down and found support at the level of the 40-day FLD in the middle of November, and over the New Year weekend it came down and found support again at the level of that 40-day FLD. So the 40-day FLD has been very important. It has formed support on two recent occasions. So I'm certainly going to be watching that 40-day FLD. I beg your pardon. I'm also going to be watching the 20-day FLD. Of course, I do enjoy the 20-day FLD, as you know. So I'm going to be watching these FLDs. It is worth pointing out that these FLDs are forming what is called a cascade pattern. A cascade pattern is when the FLDs line up very nicely, and what potentially happens is that when price comes down and crosses below one FLD, it projects a target that takes it below the next FLD, which then projects a target that takes it down below the next FLD. That's a cascade pattern. When you see that forming, you need to be wary of the fact that the move that is going to follow is going to be a sharp and a fairly fast move. So that's definitely something to be wary of and to be aware of. So on that note, I'm going to wrap up the content of this webinar. I'd be delighted to answer any questions that you might have. I do hope that you found it useful, and I hope that also, as you are watching this and as you are considering the approaching of a peak, that you bear in mind my the context in which I'm presenting this. The next big event that I believe is going to happen in stock markets is the formation of an 18-month cycle peak. And then we're going to see a move down into an 18-month cycle trough. I am not coming out and saying there's going to be a stock market crash, which some people have mentioned I might be suggesting. I'm not suggesting there's going to be a crash. I'm saying that the next move to pay attention to is the formation of a peak with a move down into the trough. So on that note, let's see if there are any questions that I can answer. Daniela, is it Daniela? Yes, Daniela asked if we are seeing a cycle series of 9, in other words, 9 years, I think if I understand correctly. And Daniela has mentioned, a 9-year cycle from the year 2000, a peak in the year 2000. Let me see if I can turn on this pen. The pen doesn't really, there we go. Okay, so we're So she's mentioning a peak in the year 2000. I think that's 2000. Then a trough in the year 2009, that being 9 years. Okay. And now another 9 years has elapsed, and we go to a peak in 2018. So that's an interesting question, Daniela. And from a Hurst cycles perspective, I must tell you that we measure cycles from trough to trough or peak to peak. So what you're suggesting in terms of measuring the distance from a peak over here in 2000 down to a trough over here in 2009 up to a peak here in 2018 is an approach taken by many cycle analysts, but it's not an approach taken by Hurst cycles analysts. So you're probably asking that question in the sort of on the wrong forum, if you like, because a Hurst cycles approach is very clear that we measure troughs to troughs, and in some cases we measure peaks to peaks, but mostly we're measuring troughs to troughs, as I hope I explained earlier in today's webinar. Because of stock markets being trough synchronized markets, we're measuring the troughs to the troughs. So we don't really measure the distance from a peak to a trough and then the trough to a peak. But I know there are other cycle approaches that do that, and there is certainly a very interesting symmetry that's developing with that 9-year pattern from a peak to a trough back to a peak again. So very interesting idea, but not strictly speaking a Hurst cycles approach. Another question also asked by Daniela was why have the US stock markets not seen any normal retracements or sort of corrections since I think that's 2011, is that right? I think it's 2011. But the bottom line is, why have the US stock markets not shown any sort of really normal-sized retracements? The market has been just accelerating upwards. It's something that we've already mentioned today. That sort of constant acceleration. Well, there are various possible reasons. I see some people saying, thank you for joining us. I look forward to seeing you in the next one. There are various reasons for that. And I think probably in our next webinar, I really should start taking a look at some stock markets from around the world. As a South African, I am always analyzing the South African stock market, and the South African stock market doesn't exhibit this complete absence of retracement, which would seem to indicate that something is happening to the American market that isn't happening to the South African stock market. And the obvious answer from the conspiracy theorists amongst us would be that it is some form of market manipulation. In fact, I received a very interesting email last week. Over the years, I've signed up for every crackpot person who's selling sort of stock market advice, just because I find it fascinating. And before I discovered Hurst and Hurst's approach, I would avidly read and in many cases buy lots of different systems. I don't buy any of them anymore, but I still read them because I really find it very interesting what people have to say. And this system claimed that, I think it was every day between 12:45 and 1:15 p.m., presumably that's New York time, billions of dollars were poured into the market by the US government, I believe, in order to stabilize the system and to make sure that the stock market keeps rising forever. Well, it was a very, very interesting idea. And I know there are many sort of conspiracy theories indicating that the US government's doing everything it can to ensure that their stock market keeps climbing forever. Whether that's true or not, or whether it's just something funny and interesting to laugh at, to brighten up our day, I don't know. Of course, I have no idea whether that's happening. Even if it is happening, I must be honest, I think that the markets are probably more powerful than anything else, and eventually, I don't believe any manipulation could possibly continue to ensure that the corrections don't happen to price movements. The markets are, after all, simply an indication of value, and at some point people are going to realize that that the valuation of a market is not really, what it says it is on the chart. There's going to come a point where somebody's going to say, I want to sell my stocks, and they're going to find nobody's really going to buy them for the price. At which point, of course, the price will move down no matter what kind of market manipulation is taking place. So that's one possible answer, Daniela. I don't know if that's the true one. It's one I find fairly amusing, fairly interesting, the concept that there's some form of market manipulation. There are various other answers, possibly the way in which the US markets have been working naturally is simply that there's been so much focus on sort of optimism in terms of productivity in America and the value of the stock market, that those reactions or the downward corrections haven't had a chance to show themselves. So I'm not sure what the correct answer is to that, but it certainly makes for a very interesting comparison. And I'm going to make a note that in a future webinar, I will definitely be looking at stock markets from other countries around the world. I might even show you a quick look at the South African stock market, an interesting market coming from an emerging country as it does. There's certainly much less market manipulation, if there is any in the US market, and so it makes for a very interesting comparison. I see Marshall says an Astro analysis compares the market in 1971-75 market after the run-up to the late 1960s. Right, compares this market, I beg your pardon, compares this market to the 1971-75 market after the run-up in the late 1960s. So that's a really interesting comment, and that would be something that's also really worthwhile to do, is go back in history and see where we can find times that the patterns are matching. And it's a very useful thing to do as a Hurst cycles analyst, is to go back and see, when the most recent period of time was where we had the current configuration of cycles, in terms of when the troughs occurred and the general shape of the market. So that's an interesting comment. Thank you. Pat says negative interest rates in Europe has caused money to come into the US market, in his opinion. So there's a possible answer to that as well. That's right, negative interest rates in Europe, which seems such a bizarre concept, but it is certainly affecting the way in which money is flowing in and out of markets in different countries. So, on that note, thank you very much for your time. Thank you for your interest in Hurst cycles. I wish you profitable trading. Enjoy the bull while it lasts. Watch out for that peak, because I do think a peak is coming. So make sure you keep your eyes on those FLDS and VTLs. And in the meantime, enjoy the bullish run. And I wish you, of course, profitable trading. And I look forward to seeing you at our next webinar.